Plan is to share straightforward information on the less talked and less understood side of the game in the market that is shorting. I want to make these videos short, covering a few concepts at a time, so let's begin. Step 1. Let's start with the most important thing to understand. Just because something is up or something is down, it never means that this is the end of the move. Apply Newton's laws to this: things in motion stay in motion. This is especially applicable to high volume runners, all-time high moves, and recent monthly highs. These will attract eyes. People wake up late, maybe they're in different time zones, they don't digest the move fully, or maybe they took a day off. Huge part of the market could be late, and where you think the move is over, there could be many new entrants who missed the initial spike and they're just waiting for the next dip to get in. As a long side trader, you need to be early, as by definition your goal is to buy low and sell high. As a short side trader, that is the opposite. For that reason, I would recommend to sit on your hands, in most cases the very first or even second day, and just let others give you a better entry. But your risk will drastically drop off if you wait 2 or 3 days. Allow more bag holders to pile in, as long as we'll try and buy up large dips, and frontside shorters will have already entered in on the previous spikes. If they don't cover on the first dip, they're already stuck. Price usually only moves insane if there are shorts in first place. Thus, if you see a drastic move, and I have OCG pulled up on the chart, rather than a steady stair-step action, you sure already know this is not just fueled by long-term interest, but rather by short exhaustion. And this is what you should aim for with patience. As a side note, you should also look for something that's not fueled by institutional buying either, but just traders. Look up what the actual institutional interest is in these companies, as a lot of them, for example, OCG, they're at 20, but then if you actually look at the institutions, they're not there for the long term, they're there to trade. So institutional ownership, you want something low, below 50%, below 20%, below 30%, something at 80%, well, that could be manipulated just too easy, and there could actually be interested parties in there in first place. I have a chart on OCG on the left, and in the next video I'll explain why my entry was on the 18th of March rather than the 16th or the 17th. Granted, I did have a small position on that day that I covered immediately into the flush, but it comes back to the first, second day, sit them out, there's no point. And actually the first day was I think the 12th. So 12 is the first day, 15th was the second day, and my position started on the 7th, so 15, 16, 12, 15, 16, I started on the 17th. So I really gave this thing a long time, and again, I'll explain in the next video why this happened, why I expected this to happen, and also why I covered when it didn't flush out after this happening. And some of it will go back, we'll talk about it just in the next section. So number 1, what I and you should primarily look for is we don't want to short real companies with an actual product making money with real institutional investors behind them with a strong balance sheet or capital investments. You could do that, and for sure there are plenty overpriced stocks in the market, but this does not fit my risk profile, and maybe it doesn't fit yours either. So you could say Tesla is for sure shortable, but they have a great product. Like your risk reward is just not there to short it, even at all-time highs. It doesn't make sense. Like you are fighting real investors with real money. So I generally stay away from that. And so for this example, that's why we're looking at OCG. It's recent, it's in everyone's memory, and maybe somebody got crushed by it, others made money on it. So we'll talk about it. So for step 1 for my investigation, you could say I use Benzinga Pro. It's faster, it's not a requirement, but for every stock that I'm looking at, I need to first understand what they do and get a general understanding of the price performance. So looking at OCG, we're looking at what they do: generate revenue through listing, fees, transactions, revenue from traders. So they're allowed to exist, but they're only making some money. So let's check the rest. Clicking on financials, incomes, it's a little suspicious that it's missing. A new company, that's fine. They don't have anything filed yet, maybe. Balance sheet itself looks healthy. Let's go to filings. That's the next thing I look at. See what we can find here. And you know, something that I found here is this December filing that basically tells you that there's a $7 a share filing for a new ticker, Jewel. And as they state, no market exists at the time, since they didn't act fast enough. They shot their stock price to well over $20, but by the time they filed this, it was already too late, and so they needed a higher stock price. Honestly, if I had seen this before, I would have probably bought them in $4 range, wherever they were, because that means they're gonna pump it up to make this happen. So that means they're gonna get their price above $7 at some point in the next several months, which is what happened. Anyways, to get a better idea, let's go to TCAT. Same company. These are the guys that spun off into OCG, same way how OCG is spinning off into Jewel, or not spinning off, but creating just new tentacles. We can get a better idea from these guys. Looking at the income statement, they're clearly not making much money. If any, this fits my profile. I like something that doesn't do anything. That's good. Also, the fact generally shady with multiple tickers for essentially the same company, I like that as well. And I like how they have current liabilities here and cash here. I mean, yeah, you could say accounts receivable, but honestly, I don't even really believe them because of what we find next. If you go to overview, again, you go to the last few filings. I think this may be the one, March 5th. So they're changing accounting firms to WWC from what looks to be much more reputable Pinchuk LLP. So just looking at the websites themselves, this already looks more serious. Just the fact that they're located in New York City, the website is way more serious. It's not done in 5 seconds. It's recently updated with information. Links work. You go to this thing, takes me 10 minutes to make this. I get it, they probably made it a long time ago, but it's just go to About Us and there's pictures missing from some of the people. So how long have you had this site and you just never cared to update it? Point is, not as professional as the previous CPA. So we have multiple flags at this point. The Jewel spinoff, the firing and switching to a shady accounting firm, potentially. That's a possibility. But whatever it is, it's not all gravy, and that's something that I want in a quote unquote company to short. All goes back to the first part of my risk management, is understanding the company, and so then I'm very comfortable knowing that these are pumps, especially with the Jewel information. However, now I wait for the pump to be over and look for the move back to the point of control. I'll go over in the next video how you know that the move is over, and in this video we'll go to part 2. Part 1 was identifying the company. Part 2 is where is it going. I usually use 1 hour, 4 hour, or daily to understand the bigger move expected, and I use volume profile that's already built into Thinkorswim. And now that we've had a proper short exhaustion and the forest covering spawned by this run, we found the top, or I think we found the top. Either way, my risk is much greater now that I think there's a decent top. My expectation is that this will make a return to Ripster's clouds. He's been pretty spot on with his system. I also think you'll go back to the volume profile. So essentially below 10, and how low we go from there, well, it could be anywhere to as low as 6. And the point is, you want to make your entries and your exits incremental. So I'm not going to exit everything. If it goes into this area of the majority of the volume below 10, I'll cover some. Goes to Ripster's clouds, I'll cover some more. 960, 744, I'll cover some more. I would think there's definitely gonna be buying here. So perfect exit is below 6. I would be happy to cover on the way there and short the tops now that we're on the back side of the move. You need to understand your entries and exits, and this is how you do it. Using volume as your primary guide, as that should always be the case. And that's where part 3 comes in, identifying supply and demand zones. So you know the top, you know it's the backside of the move, you have an expectation where it's going, but where do you enter? And so in the channel I've already shared this handy script. Now we're back to 5 minutes. You can do this yourself. The script obviously will help you identify supply and demand zones by drawing it for you. That's essentially where the volume is churning through with the price not changing drastically or the price changing drastically. And that tells you how strong the supply and demand zone is, especially if it's violent. In the case of OCG, we can see the demand area around 9 from Wednesday and Thursday. So when I shorted these pops, I was covering as early as 950 all the way into here, and I'm happy I covered most of the position, almost all of it actually. Say incremental scale in, incremental scale out, because you should never exit your entire position unless of course it makes that bounce up, then yes, cover. But while it's in the zone, the demand zone could easily shift into a supply zone and give out any support. That's not what happened currently, and that's not what most likely will happen, but it could happen. So you don't necessarily want to exit your position as soon as it enters the zone. The goal is exit some, so I did the night before. And either way, I would not recommend holding a short position that is in the demand zone or supply zone overnight, because again, things in motion remain in motion. As the price moved up, our demand zone is confirmed, and we got a very nice short exhaustion the next morning and forced covers into the morning, and then a very clear supply zone. This supply zone is much stronger than the previous demand zone due to how violently the price was rejected. So I shorted after it gave out and covered again in the previous demand zone at 955, 950. And obviously the computer didn't draw this for you, but just go ahead and extend this to a longer time frame. You can see the demand zone is still there. Ideally, I would have liked to enter more at the top and cover more at the bottom, sure, but you know, you manage your risk. And if you look at the last support candle, it was broken at 975, and to me that was part of the demand zone. So actually, like this one right here, so I actually started covering from here. I didn't wait until it went below 951. My covers were 955, 960, I believe. The demand zone is even stronger if it doesn't quite get there. Same thing for the supply zone above it. Now we have a great risk profile. We have a violent supply zone above us. I can use that to better my average, and that's my risk. I actually have a risk. And essentially I want to short all the pops above 12, above 13, 11 and a half. This is what I've done. On Friday I picked up 1250s somewhere in here early in the morning. I covered almost everything again in the demand zone at 975, and I picked up I think 1150s and 1175s on this pop. So you want to trade like an institution. They don't chase. They will buy in the demand zones and they will sell in the supply zones, and you should do the same. So I wouldn't want to go full size in here. If it goes up, hits my supply, and this is where I want to add size. For this to be an add size area, I want it to break below and go up, and then I'm adding size. Supply and demand zones are supply or demand based on where the price comes from for me. So if the price comes from the top into a zone, until I'm proving wrong, this is a demand zone. So if I'm short here, I'm covering here most of the position and I'm seeing what happens. If it breaks down, I'm not going to add and chase, but if it goes back up, which is what happened in this case, I will add some. However, if it holds, I'm not just continuously adding any. When it broke up and it went back down, if I had a bigger position, I would have actually covered some for the potential of this becoming now a demand zone because the price came from above. But in this case, there was like no volume at this point, so no volume moves pre-market, after market. You look at them a little differently. When the market was opening it up, it dropped down. I covered some more, and I added here when it came back into now what I think is a supply zone. So depending where the price comes from, this is either demand zone or supply zone. If the price comes down from here, it's a demand zone until proven wrong. If the price goes up to here, it's a supply zone until proven wrong of how it rejects. And this is how you want to trade. So I don't want to make the video too long. I just wanted to cover some basics. So A, I showed how I get the information on the company and what I look for. B, volume profile, and that's what you should look for. And C, supply and demand zone basics. And next video I'll get into more about supply and demand, support and resistance lines, how to spot short exhaustion, and how to see force coverings. Cheers.